As the world watched in stunned silence, the Chinese Communist Party dropped a bombshell announcement. China has a staggering 6 million buildings. The experts warn that China is facing an unparalleled crisis with overlapping elements that threaten to push the country into a catastrophic collapse, yet this seemingly benign piece of knowledge masks a far deeper and a darker truth. The question on everyone's mind now is, why did the CCP choose to reveal this information at this particular moment? And what does it mean for the future of China and the world? China's current dilemma stems from a confluence of causes. The country's debt level is a primary concern. Many analysts believe that China's debt bubble is about to burst because the country's debt-to-GDP ratio is among the highest in the world. The effects of this might be disastrous for the world economy as a whole, not just China. China is facing a debt crisis as well as a population rise. The country's strict one-child policy has resulted in an increasingly elderly population, which is taxing healthcare and social security institutions. As a result, economic expansion and productivity are slowing. A housing shortage is also a problem in China. However, many of the 6 million buildings in the country are either unoccupied or are being used for speculation. As a result, housing costs have soared, putting pressure on the middle class and contributing to rising inequality in the country. China is finally trying to fix its housing crisis. When one of China's largest real estate developers began to fail more than a year ago, it sent shockwaves through China's cities. New house sales have plummeted and construction cranes have ground to a halt at a number of sites, while dozens of other developers have also skipped loan payments. China's government, which has largely stayed on the sidelines of the country's housing crash until this week, has taken its most aggressive steps yet to try to mitigate the fallout from the chaos that has engulfed China Evergrande Group, the world's most heavily indebted developer, and many of its competitors. About a quarter of economic output and a quarter of bank loans in China are invested in the real estate development, making it a significant sector of the country's economy. At least 3/5 of the Chinese families' assets are in their home, and many people there see apartment living as the best and only way to get rich. COVID-19 instances have reached unprecedented levels, heightening the importance of the government's involvement. The illness have caused a new round of stringent lockdowns, which is causing problems for factories and other enterprises, reducing spending by customers and preventing potential apartment complex tenants from visiting sales offices. This has put even more stress on a struggling economy. China's cabinet issued a similar instruction to that issued by regulators hours earlier, calling for banks, most of which are state-owned, to lend more money for the completion of unfinished flats. To ensure that developers may borrow sufficient funds from banks and bond investors and defer repayment when necessary, the People's Bank of China, China's central bank, and the major bank regulator in China formalized 16 steps on the same day, and the central bank cut the amount of emergency reserves that commercial banks in the country are collectively required to hold by $70 billion. In a move that has reassured investors that it's safe to lend to the companies, a subsidiary of the central bank agreed earlier this month to guarantee the repayment of new bonds issued by some of the less distressed real estate developers. A tax credit has been established by the Ministry of Finance for those who purchase a new primary residence within a year of selling the prior one. China's top banks followed directives from the government and banking authorities this week and extended credit to major developers. Credit lines totaling $91 billion were made available by the Industrial and Commercial Bank of China to 12 different developers, the bank reported on Thursday. Vanke, the largest developer in China, received a $14 billion line of credit from the Bank of Communications. The country's central bank governor, Yi Gang, has announced the government's willingness to utilize regulatory instruments to stabilize the massive real estate sector. A further look at China. Mr. Yi said in a speech that the housing market in China is integral to the growth of the economy because it affects so many other businesses. Chinese financial authorities are under pressure to restore faith in the real estate market. As concerns about the economy linger, both domestic and foreign investors have been selling bonds and other assets and moving money out of the country. Economic growth is anticipated to be less than half of Beijing's aim of 5.5% in 2022. The leader of China, Xi Jinping, is rumored to be considering a tax increase in the wealth in order to fund more government expenditure on social programs. With that fall in Shanghai trade, bond prices have plummeted, pushing rates higher and making it more expensive for developers to borrow without government assistance. Investors have been pulling substantial sums of money out of lightly regulated wealth management funds, many of which utilize borrowed money to place big wagers in bond markets. This is another symptom of the broader financial pressure that is also harming the housing market. China's housing policy is trapped in the same rut as the country's health policy, which is mired in a zero-COVID position of lockdowns and widespread testing. Mr. Xi has taken firm stands on several issues, which has made it more difficult to find solutions to the housing crisis on the COVID policy. In light of recent declines in exports and consumer expenditure due to widespread COVID lockdowns, the already crucial role housing plays in the economy is bolstered. According to an online analysis by Han Yu-yun, an associate professor of economics at Tsinghua University, to save the property market is to save the economy. The primary question in housing is whether or not the government should allow individuals to once again treat housing as an investment rather than a necessity. It was 3 years ago that Mr. Xi's 2016 proclamation, "Housing is for shelter, not speculation," became official government policy. The housing ministry of the country developed a regulation with 3 red lines to limit the amount of money builders may borrow. The objective was to limit bank financing to developers so that they wouldn't use their borrowing power for risky ventures. When developers crossed one red line, they were forced to immediately begin repaying debt, which imposed a significant burden on their resources. Even though at least 3 dozen real estate developers have failed to make bond payments, most of which are to foreign investors, the housing ministry has not rescinded its 3 red lines policy. After home prices in China skyrocketed over the past quarter century, some analysts believe the market was already inflated and might have crashed even without the stricter policy. New property prices in China have reached 8.5 times the average annual disposal income, according to a recent calculation by Oxford Economics. This ratio reached a high of 5.8 in the United States in 2007, just before the housing bubble there broke. Some economists argue that Mr. Xi made the right move in tackling speculative activity, but the government's response could have been better crafted. Even though the direction of the policy of housing is for living, not speculation, is correct, the implementation of the policy may require fine-tuning in light of market conditions, said Zhu Ning, Deputy Dean of the Shanghai Advanced Institute of Finance. It's possible that the uptick in regulatory action this week is a first step in that process of fine-tuning. Real estate developers can issue $35 billion in government-backed bonds. Government guarantees will allow state-owned banks to buy developers' new bonds at affordable rates. New bonds will pay down old debts, due to the building industry's high loan rates. This Thursday, the China Banking and Insurance Regulatory Commission said banks can wait a year before requesting real estate developer loan payback. China's commercial banking industry can prevent a revenue drop by delaying recording a major wave of bad loans. Municipalities are getting approval from the housing ministry to relax apartment purchasing limits. Before that, many governments actively prohibited overseas investors from buying property to cut local housing costs. China's Ministry of Finance finally granted a tax vacation to keep funds in real estate sector. Real estate profits are tax-free if utilized to buy more property within a year, according to the law. This deduction will expire on December 31st, like the US Section 1031 Real Estate Investor Tax Scheme. Customers who have seen significant home value appreciation should use that money to relocate into more modern and roomy housing. This might revive China's vast construction industry. The long-term issue is that the large 1980s rural to urban migration has slowed as individuals leave their villages. Oxford Economics said last week that the yearly demand for dwellings was 8 million from 2010 to 2019, but will drop to 4.6 million from 2020 to 2030. Beijing must figure out how to handle the shrinkage of the construction sector and its many subsectors, which make steel, cement, household goods and washing machines. Construction has to shrink, said Oxford University's China Center Associate George Magnus. The question is how and at what cost. That's it for today. It's important for us to stay informed about these issues as they have implications not just for China, but for the global economy as a whole. If you found this video informative, please like and share it with your friends and family, and don't forget to subscribe to our channel for more thought-provoking content on the pressing issues of our time. Thank you for watching.